Picture this. You're sitting on your porch, morning coffee in hand, watching the sunrise. No alarm clocks, no commute, no stress about making ends meet. Just the freedom to enjoy life on your terms, knowing that every month, like clockwork, your dividend checks are rolling in, covering your expenses and then some. But here's the harsh reality most retirement advisors won't tell you. Traditional retirement strategies are built on a dangerous foundation. While millions of Americans are piling money into S&P 500 index funds hoping for the best, they're overlooking a critical flaw that could devastate their golden years. What happens when the market crashes just as you need to start selling those shares to fund your lifestyle? It's called sequence of returns risk, and it's the silent retirement killer that forces retirees to sell their investments at rock-bottom prices, permanently damaging their nest eggs. But there's a better way. Today, I'm going to reveal my complete dividend investing blueprint that can help you create a reliable, growing income stream in retirement without ever needing to sell a single share. I've spent years researching what truly makes dividend stocks sustainable for the long haul, and I've identified 5 exceptional companies that pass my rigorous criteria with flying colors. After analyzing hundreds of dividend stocks and tracking their performance through bull markets, bear markets, recessions, and even a global pandemic, I've developed a 5-point framework that separates the truly exceptional dividend payers from the dangerous yield traps that can leave retirees financially stranded. By the end of this video, you'll know why traditional retirement advice could be setting you up for failure, the 5 critical tests every dividend stock must pass before it belongs in your retirement portfolio, 5 powerhouse stocks with yields between 5.5% and 7% that can form the foundation of your retirement income strategy, and how to protect yourself from inflation while generating substantial current income. If you're serious about creating reliable passive income that can fund your dream retirement, this might be the most important video you watch this year. So let's dive in. But first, let's understand exactly why dividend investing could be the perfect retirement strategy, and why most people get it completely wrong. If you're serious about achieving financial freedom with dividends, make sure you smash that like button and subscribe for more game-changing income investing insights. The retirement dilemma. Most retirees today follow the conventional wisdom of investing in broad market ETFs, or low-cost index funds that track the S&P 500. It seems sensible enough. Diversified exposure to America's biggest companies with minimal fees. But there's a massive problem lurking beneath the surface that threatens to derail your retirement plans. Sequence of returns risk. Here's why this matters so much. The S&P 500 currently yields only about 1.2%, which means retirees simply cannot live off the dividends alone. Instead, they're forced into a dangerous pattern of regularly selling shares to cover their living expenses. This strategy works fine during bull markets, but what happens when the inevitable market crash occurs? Suddenly, you're selling more shares at depressed prices just to maintain your income. Those shares are permanently gone from your portfolio, which means fewer shares generating returns when the market eventually recovers. This creates a downward spiral that can deplete your nest egg years faster than projected. I've seen too many retirees who followed the traditional 4% withdrawal rule only to find themselves running dangerously low on funds a decade into retirement. High-yield dividend investing offers a powerful alternative. Instead of selling shares, you live entirely off the cash flow your investments generate. Market crashes might temporarily reduce your portfolio's value on paper, but your income stream remains intact. Your dividend checks keep coming regardless of market conditions, allowing you to stay fully invested through market turbulence. This approach means you never have to make the painful decision to sell at market lows, a game-changing advantage for preserving your wealth over a 20-plus year retirement. But here's where many dividend investors go terribly wrong. They chase the highest yields without understanding what makes a dividend truly sustainable. They fall into dangerous dividend traps, companies with impressive-looking payouts that eventually get slashed when business conditions deteriorate. The market is littered with cautionary tales of retirees who built their income strategies around seemingly reliable high-yield stocks, only to watch in horror as those dividends disappeared precisely when they needed them most. To avoid this fate, You need a systematic framework for identifying only the highest quality dividend stocks that can deliver reliable income through economic cycles, inflation periods, and market disruptions. That's exactly what my 5-point dividend selection framework provides: a battle-tested system for building a retirement income portfolio that lets you sleep well at night while your dividend checks arrive like clockwork. The Dividend Selection Framework. After years of analyzing dividend stocks across multiple market cycles, I've developed a 5-point framework that separates truly exceptional income investments from dangerous yield traps. This isn't just theory. It's a battle-tested system that identifies companies capable of delivering growing dividends through recessions, inflation, and even global pandemics. Let me walk you through each critical component. First, we have what I call the Fortress Business Test. For a dividend to truly be retirement-worthy, it must come from a company with a defensive and durable business model. This means the business generates consistent cash flows regardless of economic conditions, whether we're facing recession, inflation, or industry disruption. The best dividend stocks are built on business models that provide essential products or services with steady demand. When economic storms hit, these companies maintain their cash flow strength while weaker competitors struggle. This resilience is non-negotiable for retirement income you can depend on. Second is the financial strength factor. Even great businesses can be forced to cut dividends if they're drowning in debt. A strong balance sheet acts as a shield protecting your dividend income during difficult times. I look specifically for low leverage ratios, strong credit ratings, substantial liquidity, and well-laddered debt maturities. These technical factors might sound boring, but they're absolutely crucial. Companies with financial flexibility can maintain, and even increase, their dividends during recessions when many others are slashing payouts to preserve cash. Third, we have the safety margin principle. This ensures the company generates enough free cash flow to comfortably cover its dividend over time. Different business models have different appropriate payout ratios, but the key is having a substantial buffer between what the company earns and what it pays out to shareholders. This safety margin protects your income stream during temporary business downturns. When a company is paying out nearly everything it earns, even minor setbacks can force dividend cuts. The best dividend stocks maintain conservative payout ratios that provide breathing room when challenges arise. Fourth is the lifestyle yield threshold. For retirement income to be meaningful, your dividend yield must be high enough to support your lifestyle without requiring an enormous portfolio. While the S&P 500's 1.2% yield forces retirees to accumulate massive nest eggs or sell shares regularly, the right dividend stocks can provide yields of 4 to 6% that dramatically reduce the portfolio size needed for retirement. These yields are high enough to provide substantial income, but not so high that they signal unsustainable payouts. This sweet spot allows you to retire with potentially half the portfolio size you'd need with traditional low-yield investments. Finally, we have the inflation shield strategy. Inflation is a silent wealth destroyer that erodes your purchasing power over time. To maintain your lifestyle throughout retirement, your dividend income must grow consistently to outpace inflation. This happens in one of two ways. Either the company increases its dividend annually at a rate exceeding inflation, or it offers a high enough yield that you can reinvest excess dividends to generate additional income growth. Without this inflation protection, even seemingly generous dividends will gradually buy less and less as the years pass. When combined, these 5 criteria create a powerful filter that identifies only the highest quality dividend stocks capable of providing reliable, growing income throughout your retirement years. Now let's examine 5 exceptional companies that pass all these tests with flying colors, stocks that could form the foundation of your retirement income strategy today. 5 powerhouse dividend stocks. Now let's explore 5 exceptional dividend stocks that pass all elements of our rigorous framework. These aren't just high-yield investments. They're companies built to deliver reliable, growing income through all market conditions. First up is Enterprise Products Partners, ticker symbol EPD, one of the most dependable high-yield stocks available today. What makes EPD extraordinary is its remarkable 26-year streak of consecutive distribution increases, a testament to its resilience through multiple economic cycles. While many energy companies struggled during market downturns, EPD has consistently generated 10% plus returns on invested capital, even through the COVID crash and the 2018 energy sector collapse. This midstream energy giant operates a vast network of pipelines and processing facilities that transport and handle oil, natural gas, and refined products. Unlike producers, EPD isn't heavily exposed to commodity price fluctuations because its revenue primarily comes from long-term contracts with built-in price escalations. Its fortress-like balance sheet features an A- credit rating, the strongest in the midstream sector, with a conservative 3.1 times leverage ratio and an impressive 19-year weighted average debt maturity. This financial strength means EPD won't face refinancing pressures in rising interest rate environments. Currently yielding about 6.5%, EPD's distribution is comfortably covered 1.7 times by cash flow, with projected growth of approximately 5% annually, easily outpacing inflation. It truly represents the complete income package for retirement investors. Our second powerhouse is Canadian Natural Resources, ticker CNQ, which offers both high current income and exceptional dividend growth potential. What sets CNQ apart is its extraordinary reserve life exceeding 30 years, ensuring stable or growing low-cost energy production for decades to come. The company maintains one of the strongest balance sheets among oil producers, with a conservative payout ratio below 60%, providing substantial protection against commodity price swings. CNQ recently raised its dividend by 4.4%, continuing a quarter-century tradition of annual increases. Currently yielding close to 6%, this stock combines significant current income with inflation-beating growth. While energy producers generally face more commodity price exposure than midstream operators, CNQ's exceptionally low-cost assets and strong cash flow generation allow it to remain profitable and support its dividend, even in challenging price environments. With such balance sheet strength and conservative payout practices, CNQ has ample flexibility to weather temporary downturns while maintaining its impressive dividend growth trajectory. Third on our list is Main Street Capital, ticker MAIN, a business development company with a distinctive advantage. Unlike most BDCs, Main Street features an internal management structure that dramatically reduces cost overhead compared to externally managed competitors. This structural efficiency means more profits flow directly to shareholders rather than to external management firms. Main has leveraged this advantage to command a significant premium to net asset value, which creates a virtuous cycle. The company can issue new shares at prices well above book value, instantly accretive to existing shareholders, which fuels growth and attracts more investors. Currently trading at nearly twice its net asset value, Main yields approximately 7% with monthly distributions and a track record of special dividends. It boasts an investment-grade balance sheet, a conservative payout ratio, and focuses primarily on senior secured loans supplemented by strategic equity investments. While not the cheapest stock from a pure value perspective, Main represents an exceptional choice for retirement investors seeking stable, substantial monthly income with strong inflation protection. Our fourth selection is Realty Income, appropriately ticker symbol O, widely known as the Monthly Dividend Company. This real estate investment trust has grown its dividend for over 25 consecutive years at rates consistently outpacing inflation. Currently yielding over 5.5%, Realty Income combines attractive current income with dependable growth. Its A- credit rating stands among the strongest in the REIT sector, providing significant financial flexibility during economic downturns. The company's portfolio spans more than 13,000 properties under triple net leases, which require tenants to cover taxes, insurance, and maintenance costs. This diversification across property types, locations, and tenant businesses creates remarkable recession resistance and protection against e-commerce disruption. With projected dividend growth exceeding 4% annually, Realty Income offers an ideal combination of current yield, growth potential, and reliability that retirement investors should prize. Its monthly payment schedule also aligns perfectly with retirees' regular expenses. Finally, we have Brookfield Infrastructure Partners, ticker BIP, a global infrastructure powerhouse managed by Brookfield Asset Management, widely regarded as the world's premier infrastructure investor. BIP owns and operates a diverse portfolio of essential infrastructure assets, including utilities, transportation networks, midstream energy, and data infrastructure. The company has consistently grown its distribution at high single-digit rates year after year, easily outpacing inflation. Currently yielding nearly 6% with projected distribution growth of 7% over the next 5 years, BIP offers an exceptional combination of current income and growth potential. Beyond its traditional infrastructure assets, BIP is strategically expanding into AI-focused data infrastructure, including data centers projected to generate 20% plus internal rates of return. This positions the company to benefit from one of the most powerful technological trends of our era. With a BBB plus credit rating, inflation-linked contracts, and critical assets that remain essential through all economic conditions, BIP exemplifies the durability we seek in retirement income investments. These 5 companies, Enterprise Products Partners, Canadian Natural Resources, Main Street Capital, Realty Income, and Brookfield Infrastructure Partners, represent the gold standard for retirement-focused dividend investing. Each passes our 5-point framework with exceptional ratings across all categories. Together, they provide diversification across sectors, attractive current yields between 5.5% and 7%, and proven ability to deliver growing income that outpaces inflation over time. If this dividend roadmap helped you see a clearer path to retirement, smash that like button. Subscribe now for more powerful income strategies that most financial advisors won't tell you about. What's your take on these 5 dividend powerhouses? Drop your thoughts below. And if you know someone struggling with retirement planning, sharing this video could be the best investment you make in their future. See you in the next deep dive. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Investments carry risk, and you may lose money.